The moment risk became policy. For centuries, risk was something leaders tried to avoid. It was hidden, denied, or pushed into the future. Then, quietly, the logic changed. Risk stopped being an accident of decision-making and became a decision itself. To understand why this moment matters, we must return to a Europe shaped by repeated shocks. Crises arrived faster than systems could absorb them. Markets reacted before laws could respond. Every attempt to eliminate uncertainty only displaced it elsewhere. Eventually, policymakers reached an unsettling conclusion. Risk could not be removed. It could only be managed deliberately. The first reveal appears in how institutions redefine responsibility. Instead of promising safety, they began promising control. Risk was mapped, categorized, and priced. Models replaced judgment. Exposure was measured continuously, not to prevent danger entirely, but to decide how much it was acceptable. Uncertainty became something to be allocated rather than feared. The second beat followed as this logic entered policy itself. Government stopped asking how to avoid risk and started asking where to place it. Households carried more exposure. Markets absorbed volatility. States positioned themselves as backstops rather than shields. Each choice was justified as rational, technical, and necessary. Risk was no longer failure. It was strategy. What made this shift profound was its subtlety. No law announced that danger was now intentional. No speech celebrated it. Yet, policy frameworks began assuming that instability was normal, even useful, if properly contained. Crises were reframed as stress tests, losses as lessons, survival as success. By the time the public noticed, the transformation was already complete. Decisions were being made not to prevent breakdowns, but to survive them. Stability was no longer defined by calm, but by endurance under pressure. This was the moment risk stopped being a threat to policy and became its foundation. As the reveal deepened, risk began shaping incentives across the system. Institutions were no longer judged solely on outcomes, but on how well they quantified uncertainty. Success meant surviving stress scenarios rather than avoiding them. Losses were tolerated if they fit within models. Failure was redefined as miscalculation, not damage. The conflict emerged when this logic filtered into everyday life. Individuals faced greater exposure to market swings, employment volatility, and financial responsibility. Protections once assumed were redesigned as cushions rather than barriers. Policymakers argued this created resilience. Critics warned it normalized insecurity. Risk had moved from abstraction into experience. The buildup intensified during periods of calm. Without immediate crisis, risk frameworks expanded quietly. New instruments transferred exposure more efficiently. Responsibility was fragmented across actors, each carrying a manageable share, until shock arrived. Then connections became visible. Losses synchronized. Containment proved more complex than models predicted. Institutions responded by refining policy, not reversing it. More stress tests, deeper buffers, faster intervention mechanisms. Risk was adjusted, not reduced. The assumption held firm. Uncertainty was permanent. The goal was to survive volatility, not eliminate it. Public trust wavered as people sensed the trade-off. Stability felt conditional. Safety felt probabilistic. Protection depended on thresholds few understood. Policy spoke the language of resilience, but lived reality felt fragile. Risk had been professionalized, yet widely distributed. By now, the transformation was clear. Risk was no longer an external force pressing against policy. It was embedded within it, shaping decisions in advance. Systems were built expecting disruption, even relying on it to prove strength. The question was no longer whether risk could be avoided. It was who would carry it, and who would decide when it was acceptable. The tension reached its peak when repeated shocks revealed the limits of managed risk. Each crisis was survived, yet recovery felt thinner every time. Buffers absorbed losses, but confidence did not fully return. The system endured, but the margin for error narrowed. Risks had been contained, but it had also accumulated. The conflict sharpened as disparities became impossible to ignore. Those closest to policy design carried less exposure. Those furthest from decision-making absorbed more volatility. Risk distribution, once framed as efficient, began to look unequal. Survival depended not only on resilience, but on position within the system. Policy had not eliminated danger, it had redirected it. The buildup intensified when models failed in unexpected ways. Correlations assumed to be independent moved together. Stress scenarios overlapped. What was designed as diversification turned into amplification. Institutions adjusted quickly, but each adjustment added complexity. Risk management grew denser, harder to interpret, and more dependent on expert judgment. Citizens sensed the shift intuitively. Crises no longer felt exceptional. They felt routine. Adaptation replaced expectation of safety. People learned to live with uncertainty as background noise. Risk was no longer alarming. It was ambient. And what becomes ambient stops provoking action. Inside policymaking circles, doubt crept in. Had resilience become an excuse for exposure? Had survival replaced progress as the primary goal? The language of policy emphasized endurance, but offered little vision beyond it. Stability meant not collapsing, not necessarily improving. By this stage, risk had fully merged with governance. Decisions were justified by scenarios rather than values. Trade-offs were framed as technical thresholds rather than social choices. What had begun as realism now risked becoming resignation. The system could survive shocks, but it was no longer clear what it was surviving for. The reckoning arrived when endurance stopped feeling like success. Surviving crisis after crisis no longer inspired confidence. It raised a quieter, more unsettling question. If the system can withstand anything, why does it feel increasingly fragile to live inside? The climax unfolded as policymakers confronted a truth they had long deferred. Risk, once adopted as strategy, had begun shaping society's tolerance for instability. What could be absorbed by models still damaged lives. What could be priced still altered trust. Managing danger had gradually replaced the ambition to reduce it. This realization forced a reframing. Risk could remain part of policy, but not its purpose. Institutions began rebalancing priorities, asking not only whether shocks could be survived, but whether they should be accepted so readily. Preventive investment regained relevance. Safety was reconsidered not as an illusion, but as a goal worth pursuing selectively. The resolution emerged through recalibration rather than reversal. Stress tests remained, but they were no longer the final measure of success. Policies began weighing exposure against social cost. Some risks were deliberately removed from markets and reabsorbed collectively. Resilience was paired again with responsibility. What endured from this moment was a deeper understanding of governance in an uncertain world. Risk cannot be eliminated, but neither should it be normalized to the point of indifference. Survival is not enough. Systems exist to improve life, not merely to outlast collapse. The moment risk became policy marked a turning point. The moment policy remembered its purpose marked another. Sometimes the smallest shift in perspective becomes the beginning of a new future. The moment